All right, let's continue with the theme here. George Tsilis joining us to talk about connectivity and getting lost. He's our senior markets correspondent, GT. Garmin, is this all on their devices, their wearable stuff? Why is the stock doing so darn well?
Well, I think if you look at their business, OJ, it's actually quite unique business. People may know it because they have, of course, the fitness wearable devices and sports devices and adventure devices, but
Right.
They actually have quite an extensive business and commercial areas of expertise, which includes things like their auto divisions, aviation, and even maritime. So everything from traffic cameras to collision avoidance systems for cars, and even avionics equipment, of course, navigation equipment for marine, and of course the aviation space as well, which includes things like flight displays and GPS. But they also have fitness trackers, or if you will, spot trackers for your pets, all kinds of different sports and so forth, like golf range finders. But anyway, they have a very unique business. It's quite extensive, both in the commercial space but also in the consumer space. And the stock has actually performed, as you mentioned, extremely well, about 60% higher in the last year. Over the last 5 years, by the way, the stock is about double. It's up 101%. But today it's falling based upon not necessarily news associated with earnings. In fact, it was actually a downgrade. And Barclays just came out of the blue and downgraded the stock to an underperform, or underweight, if you will, and actually reduced their price target to $133. And I think the reason being is if you look at their fitness devices, in fact, if you look at last quarter when they reported earnings, that segment there was higher by 28%, but all their other outdoor connected devices were actually down about 2%, irrespective of the fact that their auto and aviation divisions actually had some pretty good increases on a year-over-year basis in growth, but their aviation business was actually flat. So the auto was higher, marine was higher, but their aviation business was relatively flat. Now, I think if you look at what Barclays is considering here with their downgrade, I think it has some merit. And if you just consider price action this year up 60%, and if you go back to 2023, the company earned about $6.71 a share. Now, just going back to last quarter when we reported earnings, Garmin actually increased their EPS guidance for 2024 to $6 a share. So that's a 71% decrease, a 71 cent decrease, than 2023, but the stock price really hasn't reflected that. In other words, it just keeps moving higher, but the earnings estimates for 2024 are actually down compared to 2023. So what Barclays is looking at makes sense. I think there is some weakness in the uneven aspects of the consumer devices because the consumer is rather fickle right now, and I think that's demonstrative of the outdoor segment, which was down about 2% last quarter when they reported earnings. And the other thing is the valuation. If you do compare valuation at 30 times this year's earnings, it's about 30% more expensive than its 5-year average, but its EBITDA margins are only a fraction higher than its 5-year average. So there seems to be a disconnect here with the price action on a relative basis to historical valuation.
Okay. So it seems like most of their verticals are clicking off pretty well, and some of this stuff is a little bit higher end, higher margins. So it seems like their financials are improving quite significantly. It was like for a while they, at first it looked like maybe Google is just going to put them out of business, basically, just because, the general technology. But they've gotten really creative as a device. And OEM technically is the industrial term, right? Original equipment manufacturer.
Yep. Yeah, that's the thing. If it was just sort of a fitness and outdoor sports device company, there's a lot of ubiquitous technologies out there. I mean, just think about Apple. You got to think about Google, which I believe bought Fitbit many years back. But nonetheless, I think their OEM business, which is their commercial, I call it their commercial business, is still quite robust, and that includes, like I said, the automotive business, the aviation, and the marine business, which it really has a lot of market share in that particular space. But if you look at their aviation growth year over year, it was flat. And I think that's part and parcel of what they're looking at here, but also their outdoor hardware division was down about 2%. So they're seeing growth in the auto segment. They're also seeing it in marine, but their other two segments were actually flat to slightly lower. But like I said, looking at the fundamentals itself, I can see that there's probably between a 5 or 8%, give or take, premium to the price contingent upon maybe what I consider fair value. But if you look at the price action today, you would think that there was more than just a downgrade, perhaps an earnings, a miss or potentially a revision, guidance that they move their guidance down, but it didn't. So I suggest here, if you look at the price action, it did hold the 50-day moving average just barely. So it traded quite a bit lower than retraced and gained near the end of the day. So I think that's an area of support to consider if you're looking at this name, because I think overall valuation, I would consider balanced, not necessarily perhaps as bearish as Barclays is looking at, which is the $133 target.
Okay. Chart looks great. Seems like it's been on a pretty good pace, a pullback here. Maybe just a reset of price. It seems like trend argues it's a dip buying opportunity without any big negative surprises on the actual hardware. But I could see where the analyst kind of negativity, right? That's kind of how it works. If you want to be in a momentum stock that's been winning, you're going to have to brave a little bit of negative commentary, perhaps, from some of these analysts. George, thank you. We got to jump. Appreciate you very much.